So this is part number 34 of this multi-part video series for positional stock traders. Those traders who want to trade only the weekly time frame charts and on positional stocks only. I have noticed that a lot of my subscribers are still confused about swing trading and positional trading. I was surprised when one of my subscribers uh, told me that she thought swing trading and positional trading are two very different things. These are two different styles of trading. I helped her understand that swing trading and positional trading are one and the same. The only difference being in swing trading, we give less weightage to the fundamentals of the stock. In positional trading, we demand that the stock be fundamentally strong. So, I want to clarify this difference between swing and positional trading in this video. So before even I look at the chart of any company, I try to determine whether it's a fundamental stock or whether it's a positional stock or a swing stock. So to do that, I need a criteria, right? So if the stock is a positional stock, I'm going to take whatever trade I take in that stock, it's a positional trade. If a stock is a swing stock, whatever trade I'm going to take in the stock is going to be a swing trade, right? So first we need a definition of positional stock and swing stock. So here is the definition. And it's an unusual definition. I talk about weakness, I don't talk about strength. See, swing stock means a stock which can be fundamentally weak. So remember the 12 criteria that I've explained to you, the fundamental criteria. If the stock shows weakness in majority of those criteria, that stock is a swing stock. Okay, it is allowed to be fundamentally weak. We can still take a swing trade in that stock, but you have to understand that there is more risk in that stock. The difference between swing trading and positional trading is swing trading is more risky than positional trading because in swing trading we give less weightage to the fundamentals. Rest everything remains the same. The number of points in the base count, the blue, green, red moving averages, everything remains the same. The only difference being the fundamentals. The definition of positional stock is a stock which cannot be fundamentally weak. So if a stock is fundamentally weak, you cannot take a positional trade in that stock. In positional trade, we have a long-term horizon. Okay. So let us define what is a swing and a positional stock. For that, you need the fundamental criteria. Remember, this is the 12 fundamental criteria that we discussed. Sales EPS growth should be 40%. It should be accelerating for 3 quarters. Sales growth should be 25%. It should be accelerating for 3 quarters. Annual EPS growth should be more than or equal to 25%. 3 years of positive annual EPS growth. Annual EPS should be at an all-time high. The quarterly EPS should be more than the annual EPS. The stability should be less than or equal to 25. Return on equity should be greater than or equal to 17%. Margin should be expanding for 3, 5, 10 years. And the margin should be at an all-time high. These are the 12 fundamental criteria. So when I am looking at a stock, I don't look at how many criteria are met. I look at how many criteria are violated. So for example, if a stock violates 6 out of these 12 criteria, it automatically becomes a swing trade because a positional stock is a stock where at least 50% of the criteria is more than 50% of the criteria is met. Let me repeat that. A positional stock is a stock in which more than 50% of the criteria is met at least. So what is 50% of 12? 6. What is more than 50% of 12? 7. Okay, at least. So out of 12, if 7 criteria are met, minimum, that to me is a positional stock. If 7 criteria are not met, if it is 1, 2, 3, 4, 5, or 6 only, it's it's a swing stock for me. Okay, I have given you a clear objective definition now of a swing stock and a positional stock. Any stock where 7 out of 12 are in your favor, 7 or more, okay, that's a positional stock. Any stock where it is 6 or less, That's a swing stock. Just remember that definition. It's very, very simple. Okay. Now let us look at some permutations and combinations in this. Imagine a positional stock, okay, where these four criteria are in your favor. Out of that seven, these are in your favor, these four. So some of these are not in your favor, but it's a positional stock, right? And imagine another positional stock where seven criteria are in your favor, but these four are not in your favor. The remaining maybe are in your favor. Out of the remaining eight, maybe seven are in your favor. Which stock do you think is more risky? Well, obviously, the first stock in which these four criteria were in your favor is less risky than the second scenario, because obviously the sales and the EPS growth is the crucial factor, right? So that's why I have placed these factors in the order of importance here. First EPS growth, then sales growth, then annual EPS growth, then quarterly EPS growth, then stability, then ROE, and then margin. Okay. So it's like EPS, sales, ROE, margin. That's the order of importance. Within that, we need that the first four: EPS growth, sales growth. Okay. These four are crucial. Okay. Now, there could be stocks where these four criteria are not in your favor, and out of the remaining eight, seven are in your favor. Okay. I would be very cautious with that stock, because maybe the sales growth is declining, decelerating, or EPS growth is decelerating. So that's a risk, right, for the stock. But that does not mean that it is not a positional stock. It is still a positional stock. Okay. But with more risk. Okay. Now come to swing. Now, in swing, we already know by definition for a swing, it either meets 6 out of these 12 criteria or less than 6 out of these 12 criteria. Correct? That's a swing trade. Now, imagine two swing stocks. In one swing stock, it meets 6 out of this 12 criteria. In another swing stock, it meets only 3 out of these 12 criteria. Which stock do you think is more risky? Obviously, the stock that meets only 3 out of these 12 criteria is more risky, right? So even in swing, I would look at positional. So, sorry, even in swing, I would look at fundamentals, right? Imagine two swing stocks, okay? Both swing stocks meet 6 out of these 12 criteria. Okay, so by definition, they are swing. Both of them meet 6 out of the 12 criteria. But in the first case, out of that 6, you have these 4 in your favor. In the second case, out of that 6, you have the last 4 in your favor, not these. Where do you think you have more risk? Well, obviously, the second scenario, you have more risk because you don't have sales growth, earnings growth in your favor. So you understand what I'm saying here. Even within swing, if you get 3 swing trades, okay, for tomorrow, you can actually determine with the help of fundamentals which swing trade is more risky, which swing trade is less risky. The game is all about risk management, right? Even in positional, if you have two positional stocks, you can look at the fundamental criteria and determine which positional stock is more risky, which positional stock is less risky. That is why I have given you the order of importance here. So remember, there is swing stock, there is positional stock. A positional stock is a stock that meets at least 7 out of these 12 criteria. Okay. There could be a stock where the EPS growth is less than 40%, but it is accelerating for three quarters. So let's say the EPS growth is 35%. It could be 10%, 25%, 35%. It is still expanding. So you have to check each of these criteria. Plus, some students were asking, what if the EPS growth is minus 25%, minus 10%, and then 22%. So it is still accelerating, right? It goes from minus 25 to minus 10 to plus 22%. So it is still accelerating. You understand? So that still counts. Okay. Even if it goes from minus to plus, we are looking at acceleration. Okay. So remember these definitions, very, very important. The first thing you have to determine after you have filtered, shortlisted the stocks, while selecting the stocks, just first get all the stocks which are forming a base, the blue, green, red, forming a base. not crossed the 52-week high. Get the stocks which are forming a base, a proper base. Once you get the stocks that are forming a base, segregate those two stocks, those stocks into swing category and positional category using this fundamental criteria. The fundamental stocks will literally stand out because they meet most of the criteria. So let's say you filter stocks, you shortlist stocks, you have stocks forming bases. Let's say you have maybe 5 stocks. Okay. Out of 5, maybe you find that 3 of them are meeting 6 or less than 6 out of this 12 criteria. Those 3 are swing stocks. The remaining 2 could be positional stocks. So now if you decide to take a trade in these stocks, that would be in the first 3 stocks. If you take a trade, that would be called as a swing trade. In the next 2 stocks, if you take a trade, that would be called as a positional trade. Okay. Now the moment you define that trade, first you define the stock, then you define the trade. Once you define the trade, then what is the implication? Right? The implication is if it's a swing trade, then our goal is what? Double digit return in 2 to 4 weeks. So in 2 to 4 weeks, if I'm getting a double digit return, which means 10% or more, I'm out of the stock. I am not doing any partial selling. Okay. I could hold on to the stock as long as it remains above the 21-day exponential moving average, but I may not uh, run the whole ride from my buy point till it closes below the 21-day. I might do some partial selling in between. Okay. So that's swing trading. In positional trading, I would be willing to hold on to the stock as long as it remains above the 50-day simple moving average, because it's a fundamentally strong company. I want to give it more time. Okay. And the normal holding period could be anywhere between 6 to 24 months. So positional trade, 6 to 24 months time horizon. Swing trade, 2 to 4 weeks time horizon. Positional trade, no specific target as such. Maybe at 20-25%, I might do some partial selling, but no specific target. In a swing trade, I want a double digit return in minimum 2 to 4 weeks. Okay. Positional trade, I follow the 50-day simple moving average. Swing trade, I follow the 21-day exponential moving average. Positional trade, more weightage to fundamentals. Swing trade, less weightage to the fundamentals. Positional trade, I give more time to the stock. Swing trade, I give less time to the stock. Okay. Moving averages differ when you are uh, taking a swing trade as well as a positional trade. So those are the differences between the two types of trades. It is not a different trading style. The only question is about risk. Or you could do one thing, you could completely eliminate this concept of positional and swing trading from your mind and look at each stock in terms of all 5 kinds of analysis and then do an assessment as to how much risk is being presented to you. So basically, you look at a stock which is forming a base, you look at liquidity analysis, comparative analysis, technical analysis, fundamental analysis, market analysis, and then you sit down and assess how much is the risk that is being presented to you, and then accordingly decide the position size that you want to take on that trade. And then once you have executed the trade, then you keep tracking the liquidity, comparative, technical, fundamental, and market on a daily basis. And then you keep assessing on a daily basis where how much risk there is in the stock. So you can remove these 2 words, swing and positional, from your vocabulary altogether if you just want to simplify. It's like on every stock, you will do all 5 kinds of analysis. But the reason why this segregation has been done is because once you know what kind of trade you have taken, it becomes much more easier to manage that trade in the future. Okay. Thank you so much.